Good afternoon, everyone, and welcome to our fourth webinar in our new FI Live series. Today, we will talk about an economic update, talk about what's going on in Washington. We will talk about some trends we're seeing within members, some funding strategies, give an update on our housing and community development programs, and wrap a few things up with some upcoming events that we have here at the bank. For some housekeeping items, this will be recorded. A copy of the slides and replay link will be sent to use. The Q&A, you can submit your questions with the Q&A box at the bottom, and we will get to those at the end. And as a reminder, there is an opportunity to receive one CPE credit for attending today's session, and then also participating in all of the polling questions to receive that credit. My name is Leslie Mondesir, and I am the Marketing and Member Solutions Manager here at the bank. And I am joined by Drew Simmons. He is our Oklahoma Account Manager. And we will get started today with our slides. And I believe we are starting off with a poll question here on the next slide on indicating whether or not you need CPE credits, and then kind of what topic you are most interested in hearing us talk about today.
Appreciate your responses. Continue to participate in these polls, guys. That certainly is helpful for everyone on the call as well as us. And we've got some recurring poll questions that we'll bring up and kind of talk about some of the trends that we've seen with those responses. How a lot of things have changed since our last webinar. So I'm going to kick things off with a discussion on the economy here. I'll also talk a little bit about some policy implications. Naturally, there's a lot going on. It's a very fluid situation. We're continuing to monitor it, and we'll continue to pass along information as we see it come down the pike, and let you know how we feel it'll impact the home loan bank system as a whole, our members in our district, in our four-state region, and keep you updated as new information comes. I know it's like drinking from a fire hose these days, but yeah, we'll kick things off talking about the economy. This next slide is just an overview of some things that have changed since our last discussion. First things first, what the Fed's doing. We're two pauses in now, likely more to come. We had some minutes released yesterday from the Fed. Clearly they're in a holding pattern, right? We've got, a lot of uncertainty as to the impact of the new White House administration and Trump's policies, how that will impact inflation, how that will impact growth. A lot of that is just quite frankly very, very uncertain at this point. But we can point to some things that have happened in the first administration with his, especially with his tariffs, and how that translated into just various indicators in the economy overall. GDP is basically flat at 2.8% still. We haven't gotten a new print there. The big numbers that kind of came as a surprise recently is inflation. Core PCE and core CPI both had an unexpected pop increase. So while we saw inflation, really plummet, you can kind of see that green line there to the right. Leading up into the first of the year, it went down, and then now we've pretty much erased all of that going back to December of last year. Unemployment rate, however, continues to be good. The labor market seems to be relatively strong, continues to be so. We did see some improvement in home price appreciation, maybe some slowing there towards the end of last year, mid to end of last year. Now we're starting to see that increase. The big issue with housing right now is supply. Supply is very, very tight. We're not seeing much movement in housing at all. and a lot of that has to do with just the homes that are available for sale right now, not much on the market. And I think, really what this slide to the right, kind of the chart of the day, if you will, is telling me that really since the last FOMC meeting, we've seen, the situation where expectations on growth look to probably be slowing. This is the surprise indexes are trying to take metrics that come in outside of expectations. While inflation is obviously increasing, while growth isn't. Does that mean that there might be any sort of stagflation issues? That's kind of a bad word, and we certainly don't want that in the economy. It remains to be seen because right now the labor market appears to be fairly healthy. So, so we'll continue to monitor that going forward. Next slide here, I just wanted to get a quick poll question on your outlook for the Fed's policy decisions. Like I said, we're already in a little bit of a holding pattern, but what's next? Do you think that maybe one, we'll have another pause, which seems likely based on the Fed minutes yesterday, followed by a few rate cuts? Or do you think they'll pause and maybe inflation will continue and we'll see some rate hikes? Or just, I don't know. And I think there's a lot of folks out there that don't know. Very unsure as to what the Fed's going to do until we see some cooling in inflation. Maybe that might, justify getting back into a rate cut scenario, or maybe inflation continues to increase and we might want to start seeing some Fed hikes by the Federal Reserve. So it looks like we got most of our responses in there. Go ahead and share those results. Yeah, so about 2/3 of you feel that we'll still eventually start to get into some cuts. And, about a quarter of you are unsure, and that's certainly understandable. Very few, though, are looking for maybe a potential rate hike type of scenario as we move into the year. So that's, that's interesting, but again, it's a lot of uncertainty. This slide here is really just kind of a tale of the times since the last FOMC meeting, we've seen rate cut expectations have come down significantly. You can see there we were expecting, another maybe 50 basis points. Now we're, got as low as maybe only a quarter, about mid-February or so, kind of bounced around. Again, this erratic sort of up and down is certainly an indication of that uncertainty that many of you on the call today feel like we are at. On this next slide, it's just kind of looking at some of the inflation indicators, but also charting the savings rate, right? One issue that we talked about a lot is, the debt bubble. We talked about that in the last call. The consumer debt continues to increase while inflation certainly is ticking up here lately. So we don't want to see those move in the opposite direction. You don't want things to become more expensive and folks putting fewer dollars aside for a rainy day. And that's certainly what we've seen here just over the last 6 months of 2024. You can see the change in outlays in that orange bar, the change in DPI, disposable personal income in the blue bar there. So we'll continue to track it. The hope is that inflation does cool to a certain extent. That's the rub with inflation. We want some of it. We don't want it too low. We certainly don't want it too high. And any of you on the call that can share Leslie and I's struggles with finding eggs and maybe considering getting a chicken coop here before too long. Just went shopping for the family just the other day. I found 1 carton of eggs. So that's always fun when you're dealing with that. So hopefully this last pop in inflation was short-lived and we don't really see the types of numbers printed in late 21 into 23. This next slide here, just looking at the recent trends in CPI specifically, you can see there we're tracking headline CPI there in blue and the red dotted line there for core CPI. Now, keep in mind, the Fed's, typical gauge of inflation is core PCE. A little different than core CPI, but generally they track pretty similar. The problem with that, I think, for most average consumers is like, I don't care because why you're stripping out food and energy. Well, that's a big portion of my bill every month. So it certainly cooled quite a bit mid last year, but has been on the rise since September, and even core CPI has been inching a little bit higher. On the next slide, housing is a big deal for us, and we're seeing some weakness in the housing sector. Housing starts just printed earlier this week, and it's printed at the lowest levels going all the way back to March of last year. So fits and starts there. There's certainly been a slowing in construction. There's certainly been fewer folks out there looking to build new, despite the fact that the supply of existing homes continues to be a challenge. And so we'll get into some of the things that we're doing from an affordability standpoint. Our programs, we've got a new mortgage rate reduction program. Kind of trying to bend over backwards as much as we can to try to mitigate that. But in all honesty, we could be in this kind of 7% mortgage world for a while, and it takes, as you know, with your financial institution, if you've got a mortgage team, you've seen the struggles. You got to get pretty creative in these markets, whether it's taking advantage of our grant programs or down payment assistance programs, other down payment assistance programs layering on top of that, maybe also taking advantage of our new mortgage rate reduction program. All that might really, move the needle between a customer of yours that couldn't justify the home purchase, and maybe those can move them to the other side of the fence. This next slide here just looks at that question surrounding home builders and how confident they are, and sure enough, it tracks right in with privately owned housing unit starts. So basically just that housing starts that we just talked about. So when things aren't looking good on that angle, home builders tend to have less confidence about the market, and certainly that has happened since December, where confidence would look to be pretty high, and it's definitely declined quite a bit, lowest level of confidence that we've seen going all the way back to December of 23 in that index. This next slide here talks about the credit side of the equation. We talk a lot about, the labor market seems to be healthy. The housing market, despite the challenges with supply, really hasn't shown any cracks insofar as credit weakening, but the latest prints that we've seen do show an increase in that delinquency bucket of 30 to 60 days late. You can see that in the blue bar there. 90 days late, that's that bucket that's this, quote unquote, serious delinquency rate, pretty low still, right? We're not seeing nearly the pop that we saw, if you want to go back to the 08 crisis, you can see that 30 to 60 day lates were certainly increasing pretty steadily, as did serious delinquencies outside of 90 days. So haven't seen a big pop in the 90-day bucket, but certainly we have in the 30 to 60-day bucket. But what's kind of interesting is if you look at this next slide, it compares the transition rate, right? So a lot of folks are getting back to current. So if they missed a payment, 1 month, they get back, the next month, and maybe it was just a bad month for their overall budget. Who knows, right? The question is how many of those move to 90 days, and we have seen that. So the green line is those folks that were late, maybe 1 month, and they get back on track. That's increasing. That's a good thing. But we're also seeing a relatively noticeable increase of the folks that were in that 30-day bucket moving to that 90-day bucket. So, I think what's going to really be telling here is the fact that, the home price appreciation that we've seen across the entire country. And this is unlike the '08 crisis where it was just a few pockets of areas that really had a run up in mortgage activity, housing activity. I mean, these are just, the Sand States and maybe, the Denver area in our market, for example, certainly saw some pretty significant run up, and what goes up, must come down in an economic recession like that. It was a housing-led recession. But this go round, the run up, so to speak, has really been prolific across the entire country. You've got states like Idaho experiencing the greatest degree of home price appreciation, and some more rural areas that really didn't see that in the '08 crisis that are starting to see that now. And in our district, we have the largest share of community-based financial institutions. We've got the largest number of members, and most of those members are smaller in nature. We certainly have some larger members, but we have the largest concentrations of smaller community banks and credit unions. And that's been a constant conversation in our ALCO meetings, in our strategic planning meetings, is, what does this look like in case we do have a softening or maybe an official recession? And I think what we're going to see is that, a lot of folks that got out there at a very high mortgage rate, at a very high home price, will probably see some affordability issues on being able to maintain that mortgage payment, quite frankly. So we'll continue to monitor this, but I think it's interesting to see that we are seeing an uptick in that transition rate from the 30-day bucket out to the 60-day bucket. Okay, let's talk a little bit about tariffs. This was this next slide here, is a piece that Goldman Sachs recently put out. I thought it was interesting to compare the kind of the reciprocal tariffs that we might see based on President Trump's announced and maybe more likely, so they've kind of broken that out there, of tariffs on other countries as well as on specific goods that we trade. So you can see the list there, and then as a response to that through other countries, what would happen from the standpoint of are they going to apply some tariffs on their own trading? So that happens literally anytime we establish I hate to use the term trade war, but it does become a little bit of that, where you have any type of policy decision that comes from the United States. We don't live in a vacuum, and there's going to be some global responses to that. So I just thought it was fairly interesting the way Goldman put that out. Now on this next slide, it's really just showing same piece that Goldman put out the other day. How much of an impact this is happening with companies across the country and really globally. The talk of what is this economy going to look like if a lot of these tariffs are imposed. And you can see that the share of management teams that mention tariffs in their minutes have significantly increased. And so you saw that, of course, in Trump's first term. You can see that back in kind of mid 2018 or so, and sure enough, we're now seeing a huge increase in the talk of tariffs. So, this last slide I'd like to wrap with here, and I thought this was kind of an interesting way to look at, what maybe CPI inflation would look like compared to the 1995 era, where we had, runaway inflation, and of course, that was probably the largest, increase in inflation that we've seen in our modern economy, if you will. And so they've tracked that same trajectory to the current trajectory, and it's right on top of each other, right? You saw kind of some bouncing around here, but then a pretty big pop, maxed out there in 22-ish. And then, you can see that, of course, we're now into just the first quarter of 2025. The question is, are we going to see a similar pattern that we saw in 1985? I certainly don't have the answer to that. We don't want that. The Trump administration certainly doesn't want that. But it could be a consequence of more of a nationalist kind of policy perspective. And, it's an unintended consequence, but it's definitely increases to inflation. Now, what does that mean for us? Well, if it gets even close to where we saw it in mid-2022, then liquidity is naturally going to get even tighter from here. Funding is going to become that much more of an issue for our members, and we'll certainly, be at the ready to help you with your funding objectives. So, with that, I'm going to go ahead and again, if you have any questions, don't hesitate to put that in the Q&A there. But wrapping with our discussion on the economy, what is your biggest concern that you have with your local economy? This is a recurring question that we've had, and we've seen some kind of changing of concerns, if you will, over these last about a year now that we've been doing this webinar. Is it inflation? Is it housing affordability? Is it unemployment? Or is it delinquency? So I'll give you a little bit more time here to let those filter in. Looks like almost everybody's done. All right, so the largest category here is inflation. Of course, you're just coming off the heels of looking at, hey, what if it turns right back around like we saw in 2022, and what if it mirrors the era of the mid 80s? So about half of you feel that that's your major concern. About a quarter of you are in the rising delinquencies camp. At the beginning of last year, inflation was almost 100% of everyone's responses. As we moved to the mid-year, rising delinquencies kind of took the number one response. And then, the last webinar we did in 2024, it's kind of a mixed bag, similar to what we're seeing today. But certainly, the lion's share of you look to be concerned mostly with inflation. So we'll continue to track that. Okay. Now that we've wrapped up our discussion on housing affordability,
we have one question. We have one question here for you. What are your thoughts on the dollar, the growing debt crisis, Doge, and a Bitcoin/crypto strategic reserve? So a couple items.
Yeah. A loaded question. So when it comes to Doge, I'm going to talk about that here in a second. So I'll be able to hopefully answer your questions there. My outlook for the average consumer, as well as for our national debt, is that it's untenable. I really don't feel that the average consumer is at all prepared for those sort of crisis level events that could occur: loss of a job, downsizing, or not getting the job you really want. And then that could certainly put pressure on delinquencies, and that's how you get a recession. I'm not necessarily predicting a recession, but if you look at prior economic cycles where whether it's a recession to whatever degree, the consumer is usually the last holdout, right? I mean, it's almost shocking leading up to a recession how long the average consumer can survive on tilt, if you will. And this time, compared to, let's just say the 08 crisis, for example, on the credit side of things, it's not a fair comparison. Since 2008, the credit side of the equation has certainly increased significantly by way of regulation, by way of banks and especially mortgage originators really tightening their belts. You don't see the esoteric type loan programs that you saw that led to the 2008, was a contributing factor to the 2008 crisis. So it's not really a matter of credit, but it is a matter of affordability. And, for the first time in a long time, many decades, folks are, buying homes and cars, with loans at rates that we just, are significantly higher. And that does put additional pressure on any consumer that's faced with loss of a job or anything like that. So, now once we get that economic data, the writing is on the wall, right? That's a lagged economic metric, unemployment in general. It's really difficult to track that. I think the other question was crypto. I got to say, I don't know. I think that, for our purposes, I think it behooves us to at least consider that, the Fed and other central banks, for that matter, across the globe, are eventually going to move into the digital currency space. And so, insofar as anything else regarding crypto, I got to be honest, it just not my wheelhouse. I'm not an expert there. We have very, very, very few of our members in our 4-state district that participate in crypto. We have some, but mostly have stayed away from it. So I'm unsure at best when it comes to the impact of crypto in the capital markets. Okay, to answer your question on Doge and policies, we'll go ahead and jump into that discussion. So policy implications. When they say Doge, I always think of this dog for some reason, because, back in 2013, this was the Doge meme or whatever, and I just thought it was silly. But now it's an official part of the White House administration's policies and the programs that they're doing, trying to cut as much spending, cut the fat. Look, no matter what side of the aisle that you're on from a political standpoint, I think everyone can agree we can do better from a government efficiency standpoint. It's always been kind of a running joke. I think there was that scene, in Independence Day, it's like, yeah, where do you get the money to fund all this stuff? And the older man says, what do you think that they, really actually spent $20,000 on the toilet and $5,000 on the hammer? So, it's a joke, but at the same time, there's certainly a lot of fat to be cut. Do you do it more with a scalpel instead of a bazooka? That's not Trump's MO, but at the end of the day, that the kind of running catchphrase with President Trump is, don't take him literally, but take him seriously. And things are moving at a fast and furious pace when it comes to policy. So a few considerations here to talk about. One, we're not seeing on this next slide, we're not seeing, let's talk about Doge for a second. We're not really seeing so far anything in those cuts that have a direct impact to the home loan bank system, meaning that any cuts to funding to the home loan bank system or anything like that, we're mostly self-funded. We are a government-sponsored entity, but talking about other policy implications outside of Doge is we expect the nomination hearing for Bill Pulte, who is Trump's pick to be the new FHFA director. The FHFA is our regulator. Rumor is that'll occur maybe as early as next week or into March. We don't know. But what I think that the White House administration has done initially is get the hard picks nominated first, right? I don't, if they can get some of those more difficult nominations done, and they have, we don't really expect much flack when it comes to Pulte's nomination. We'll see. We're certainly not in the game of predicting who's going to be where at the end of the day, but hopefully we'll get some more concrete information once that nomination hearing begins. Democrats will certainly, put into task insofar as the housing affordability issues and what the home loan bank system can do about it. That being said, in the scenario that Bill Pulte is nominated as the FHFA director, we're likely going to see some positive changes when it comes to our regulator, okay? And what that means is that probably a little bit of a better working relationship with our regulator, less pressure on kind of probably, some finger pointing, if you will, on who is to blame for this housing crisis. I think practically speaking, the home loan bank system can only do so much. We can have all the programs that we want to implement, but at the end of the day, if they're not being used, or if they can't be used, we're a little bit hogtied, right? And so, that remains to be seen. But I think that net, a lot of the talk surrounding FHLB at 100, the talk around more criticisms to how we operate with our members are likely to be subdued. Other nominations at the HUD, Scott Turner. There is talks of recap and release of Fannie and Freddie. We don't hesitate to remind our members that as a GSE, we never fell under conservatorship. We never had the issues that Fannie and Freddie have, despite being in the same kind of GSE bucket. It's interesting that those talks are already starting before any official appointments have been made at the HUD. The CFPB is very high on the list from the Trump administration, very chaotic right now. Jonathan McKernan is Trump's nominee for CFPB director. I think a lot of our financial institutions will welcome some relief when it comes to the regulatory burdens that have been imposed by the CFPB. And, maybe the hope would be less politicized going forward and more pragmatic policies that can help the banking sector as a whole. At the OCC, Trump's nomination is Jonathan Gold, and we haven't heard anything yet on the hearing there. This second to last bullet point here, the home loan bank as a whole, we just wrapped up our system-wide meeting down in San Antonio a couple weeks back, and we're hoping that there's going to be less political friction going forward with the FHFA. Like I said earlier, we'd like to see more of a working relationship with the FHFA. So the hope is that will continue. But as we get closer to March, keep in mind that the talk that we'll really hear most about is going to be the deficit. It's going to be the debt ceiling, and that's really going to, excuse the pun, trump any of the other policies to date. So once we get to that point, that's really going to be the main focus. Okay. With that, I am going to turn it over to Leslie, and we will discuss some financial trends from our members.
Thank you, Drew. We are going to start off with a poll question. This question is going to look familiar to you if you have registered for our upcoming annual member conference, or AMC. We've asked this question: what are your top concerns for the year over the past few years, just to get a feel for what's top of mind for our members. When we looked at the attendance for AMC in the past and kind of cross-referenced it here, we thought it'd be a good additional audience to ask this question to. A year ago, cost of funds, deposit growth, liquidity, and loan growth dominated the responses, which is kind of looks like what we're seeing here. Technology has also kind of been on the rise compared to a few years ago when we first started asking this poll question. And leave it open for a few more seconds here so people can get their choices in. I believe it's multiple choice, so you can select your top few. That would be great. Go ahead, we can close the poll here. And looks like deposit growth, I don't think there's any surprise there. Cost of funds continues to be a challenge for our members, both growing, retaining the deposit base, and what that cost to do so. Certainly impacting financial institutions, and asset quality is on the rise, which we haven't had much the past couple years, and goes along a little bit with one of the questions that we had with Drew and rising delinquencies. So we will keep our eyes on that as we move through the year. So if we can close out the poll, and then we can go to our next slide here. We'll look at balance sheet changes. for our members. Banks are across the top, credit unions are along the bottom, looking both quarter over quarter and then year over year. In the fourth quarter, on the left side there, small banks posted more asset growth while balance sheets contracted for our larger members. That was largely based off the paydown of borrowings, which you can see there, most of which was BTFP funding that was still outstanding. And we did see paydown of BTFP funds across all sectors, all sizes of institutions, types of institutions. And you can see that here on the slide, both quarter over quarter and year over year. Throughout the trends section, the blue bars are going to represent the larger institutions for both banks and credit unions. That's greater than $1 billion for banks and assets greater than $500 million for credit unions. And then the gray or dark gray bars or lines on future pages will be for their smaller peers. During the fourth quarter, also, you can see it's a welcome sign to see some growth in deposits there across each group, especially when deposits fell big at U.S. banks in the fourth quarter. So the big banks, you see articles where they had some contraction in deposits in the fourth quarter. So good sign for our community banking institutions here in the middle of the country to see that deposit growth. In terms of lending activity, we did see ag lending jump quite a bit in the fourth quarter. This does follow historical borrowing patterns, and balances reached a new high for our ag-focused members. Banks also saw loan growth in 1 to 4 residential lending as well as multifamily lending, and smaller banks had stronger loan growth than their larger bank members in the fourth quarter, pretty significantly, that you can see there in the top left chart there. Credit union lending activity was pretty muted in the fourth quarter, both quarter over quarter and year over year. Growth was in residential and home equity loans. That was offset by declines in vehicle and other consumer lending activity. On a year over year basis, on the right side, larger institutions experienced more growth on both sides of the balance sheet compared to their smaller peers. You can see that with the movement there in the blue bars. Credit union share deposit growth occurred primarily in share certificates, while banks, they saw loan growth in both non-maturity accounts as well as CDs. We just list out a few bullet points, some key balance sheet takeaways from what maybe not be in the slide in front of you, and then just something else to have to reference. In terms of the mix of liquidity positions on balance sheet, it was mixed across entity type. Credit unions that we'll see in a few slides, their liquidity continued to expand, while bank members, their liquidity positions remained relatively low, and contracted a bit in the fourth quarter. We talked about loan growth, borrowings, the decline of borrowings primarily due to BTFP, growth in deposits. Regarding deposit, the mix towards CDs and maturity accounts, it's moderated. The growth in CDs was slow, and even declined a bit for our larger members, as they saw non-maturity accounts a jump in the fourth quarter. Unrealized loss positions in securities portfolios that continues at the higher rate environment that we continue to find ourselves in. This is limiting members' ability to use their securities portfolio as a source of asset-based liquidity and to fund that loan growth that we are seeing. Many members have executed securities loss trade transactions to help reposition their portfolios and to improve earnings on a go-forward basis. Particularly our publicly traded members. We are still hearing members continuing to look at that transaction, and we're certainly seeing it across the industry, even outside of our district. And then the next slide, we will look at a couple things. So on the top, we have banks again, credit unions are along the bottom. On the left, loan growth, less deposit growth. That's going to be average trailing 4-quarter loan growth, less a 4-quarter average deposit growth, and the relationship between those two, going back a few decades. On the right, we'll look at wholesale funding and liquidity versus Fed funds rate. Like we talked about, have mentioned that wholesale funding use continues to remain elevated across our membership. While it's fallen a little bit in the last quarter or two, again, mostly related to BTFP, advanced balances are hanging in there. There are members that have transferred, paid down BTFP, and then if what funding need still remained, a good portion has shifted to advanced activity. So it's been welcome to get some of those advances over. On these charts and the following charts, you'll notice the gray shaded bars, and those are falling rate environments to highlight the activity of what we've seen in prior cycles and as we've started and pivoted into the falling rate and now paused environment. On the right, you can see liquidity. That's going to be the blue lines on the right. Liquidity build isn't quite happening like it has in prior cycles, at least for banks. Credit unions have generally trended upward. We saw on the prior slide that cash positions have been relatively unchanged, both quarter over quarter and year over year. And then if you look at that blue line just before the gray shading, you'll see that liquidity bottoms out or kind of troughs before rates start to fall. And credit unions tend to do that a few quarters before banks do. And we at least for banks, we're continuing to in prior cycles. Related to, is today different given as security portfolios remain underwater? That contributes. And then wholesale funding, that's going to be the dark gray lines that I mentioned, remains elevated, not just in terms of dollars, but also in the number of members that are using wholesale funding. We have a historical high number of members that are continuing to access wholesale funding, and more members are using multiple sources of wholesale funding. They are diversifying their funding and using broker. They used BTFP when it was available, as well as advanced funding. We will look at continued margin expansion that we've seen across both banks and credit unions. We got some relief on the funding side, as you can see there on the right. In the fourth quarter, for banks, those are banks greater than $1 billion on top and less than $1 billion on the bottom. You can see that gray line, cost of liabilities, really got some relief in the fourth quarter, which certainly contributed to the expansion in margins that we see on the left for both banks and credit unions. We had almost 70% of our bank and credit union members are seeing margin expansion. Smaller banks continue to outperform their larger peers. And for credit unions, margins, they've eclipsed their prior cycle highs, while bank members are reaching their 2022 peak with room to run. For banks, asset yields fell quicker than funding costs during the prior cycle down. That's on the left gray shaded area of the charts on the right. We'll see if this trend repeats, especially as some CRE loans and other fundings come due and look to reprice. And if rates stay higher, they may get to reprice and adjust at a higher rate, which would be welcome to earnings performance. And as we talk about short-term, or as we talk about funding costs, we'll look specifically at the deposit portfolios on the next slide. And is currently at across the district. So on the next slide, here we go. Shorter term, these are deposit pricing scatter charts that we have, one for each state. It's going to show time deposits. It's a range for those institutions that do report their deposit pricing is available. You can see the range of rates that are being offered for various terms and months that are along the bottom. We have Colorado on the top left, Kansas top right, Nebraska bottom left, and Oklahoma The blue lines or dots are going to be standard rates, and the yellow diamonds, those are going to be special offerings that are currently available for consumers to lock in higher rates. And you can see that the distribution, the lower terms, or the shorter term CD pricing remains relatively high, and that's across the district. Money market offerings, that's going to be those on month 0. A wide range of pricing options and specials out there for consumers looking at money markets. And this may be an opportunity to shift some of the share and deposit mix from CDs into higher yielding money market or savings accounts, especially with the wave of upcoming maturities. Some competitors, they've started lowering rates on accounts, while others, they're continuing to play defense and holding higher rates. And with an evolving rate outlook and higher for longer environment still on the table and where we're at today, this analysis of looking at the data of your members or depositors, and what those relationships are with you in terms of repricing these upcoming deposits will be crucial as we continue to move through this rate environment. And on the next slide, we've showed this last quarter, and showed it again, just because the upcoming term maturities, it's keeping pressure on funding costs, like we saw on the prior page, where rates are, and they continue to remain elevated, especially on the shorter end of the curve. There's a lot of term funding that's maturing, especially CD funding, as we move here in through 2025. And then in the top left here, you can see the cost of time deposits, the blue line, versus the cost of borrowings. Cost of borrowings declined in the fourth quarter, in part from paying off BTFP, and also for members that are staying short with their advances, whether that's OLOC or SOFR adjustable advances. Those rate declines are being passed through on the advance costs. So funding costs are improving, especially on the short end compared to where we were a year ago. And on the right is a trend for banks and credit unions of share and deposit funding costs versus Fed funds rate. Now, we're all familiar with the betas and how they, especially for banks, were quite a bit, felt like they were under pressure more, and they were certainly higher for larger members than maybe smaller members through the last cycle. So there's going to be an opportunity to take advantage of that also on the way down. And then on this next slide, we took a look at the funding profiles for our member institutions that do utilize wholesale funding, whether that's one source of broker deposit or advances or multiple sources. And we took a look we broke out cost of funds for our members greater than $1 billion and less than $1 billion. And we looked at the bottom quartile of cost of funds, middle quartile, and top quartile, and looked at the funding profiles to kind of see what information we could learn about the funding mix and composition versus the cost and what impact that might have on earnings. And what we saw was, if you look at the funding composition, those two black arrows in the middle, those should be down a little bit, but we want to look at advances and broker deposits. And you can see that those members in the bottom quartile, or even they have a higher concentration in advances at 2.75% on the left, or funding composition. And if they have a higher concentration in advances, and if you look in the table below it in the cost, you'll see the cost of those borrowings, which does include BTFP as well, is lower than that of time deposits greater than $250, which is where most of those brokered deposits that's the bucket they're going to fall into. And as you go to the right, again, on the top quartile of cost of funds, you can see advances for both is less of a percentage of the funding mix than brokered deposits is. And then if you look at the cost, brokered deposits generally, they've become more efficient in their pricing, They don't have the lag like they necessarily may have had in prior cycles. And so the cost of brokered deposits increased quicker. Broker deposits, diversified funding mix, that's prudent. But maybe this just is maybe a pause to consider your funding strategies and look at advances, maybe to incorporate a bit more into your funding strategy, because it could provide some benefits to your earnings profile by reducing the interest expense. And Drew, I don't know if there's anything you want to add here.
Yeah, no, I just would point out that, a lot of this, you could kind of look at it in a number of ways, but, one of the tenets that we always talk with our members about is, a diversified funding mix, no matter, how you kind of dole it out. There's certainly a lot of opportunity in the broker deposit space because it is so erratic. And one thing that we've noticed is that over these last couple of years, we've seen with the rise in rates, especially in the short end of the curve, a lot of pricing in the broker deposit space that is sometimes attractive. And I'll be the first to tell someone, hey, take a cheap deal when you get it. And I think in mixing in brokers and advances and a lot of different wholesale funding options for you is always a best practice. But, I also want to take a step back and, before the COVID crisis and the run up in interest rates and all that, the main theme when it came to your, deposit or share concentrations and is that, the CD market, for example, is kind of a dying thing. The running joke is, ask anybody under the age of 30, what a CD is, and they'll say, is that what you used to listen to music on? And that kind of shifted back in favor because of the attractiveness of a lot of the CD offers that were being offered at the time. But, it's likely a short-lived market. So, the availability of that funding is likely going to continue to that long-term trend of, fewer folks utilizing it. At the same time, we're also seeing new competitors into the space, non-banking entities. We saw that certainly over these last couple of years. So we'll continue to monitor the use of CD pricing. But part of the reason why the prices themselves are kind of all over the place is that it's kind of it's a symptom of a dying market. And you'll have institutions out there that'll put some attractive pricing out there, but it's usually short-lived. So keep your eye on those markets and take advantage of funding when you can. Same thing with when BTFP rolled out. I mean, it was incredibly attractive for a lot of our members. Again, that was most certainly short-lived, and is officially gone unless they sort of revisit it in another way. But a lot of the conversations we're hearing from members lately is surrounded by, hey, I'm here for my examiner to make sure I'm testing my line. We've had a lot of that going on lately. Not just that, oh, I've got the home loan bank. Well, we want you to physically test that line. So I would encourage you, if that's not part of your strategy, to make sure you're testing your lines with us. Make sure you're comfortable with your capacity. And look to ways to increase your capacity if you're maybe kind of riding it a little lower than you'd like. So other than that, this certainly tells an interesting story that a more diversified funding mix actually does translate into better performance, whether it's your cost of funds, whether it's your net interest margin. So something to consider going forward.
Absolutely. We can move to our next slide. We got to push through our funding strategies. Credit, we talked about normalizing, starting to see some increase, in non-performers, growing delinquencies off of very low levels. Member bank CRE and C&I were elevated in the fourth quarter. And vehicle and some residential loans. And you can see capital trends there are trending upward. which is remains on solid footing. So we are going to move into a poll question on expectations, loan expectations, deposit growth expectations, and then where funding needs are currently being concentrated, staying short, kind of some middle term funding or longer term funding. Let's see here, it looks like majority of folks are in the 3 to 5% loan growth range, matching on the deposit side. Certainly a little bit more on the 0 to 2% low deposit growth, and then greater than 5% for a handful of members. That's great. And then funding needs staying short predominantly. All right, so what are we looking ahead to in 2025? Cost of funds, mentioned that at the beginning with concerns, along with deposit growth and retaining on deposits, outlook on the economy. And then I did add regulatory landscape, how we're kind of in a transition period. And Drew spoke to that about what's going on in Washington with the new president. The impact of fiscal actions remains to be seen, along with pending appointments at the regulatory agencies, and then also geopolitical issues globally are also is something to keep an eye on as we head through 2025. And then we're going to move now into funding strategies. I know we're tight on time, but here we get asked the question a lot of what are other members doing? So here we put together a summary of what the change in our advance mix over the first 9 months of 2024. We have not filed our 10K yet, so we'll speak to the change between December of 23 and September of last year. The notable change there listed first that we're going to look at a couple funding strategies for OLOC and short-term fixed rate advances. We've seen a sizable shift over into SOFR adjustable rate advances. That product grew $9.9 billion in 9 months. We did introduce short-term SOFR or shorter SOFR terms last year. The 3-month term was rolled out in April, and 1 and 2 month SOFR adjustables were rolled out in November. Puttable advances were a popular funding option last year. We had a growth in balances of over $1 billion, so pretty significant, with popular structures listed here. And it was utilized by a very wide range of members, from very small members to very large members, banks and credit unions. The members were looking for some margin relief that was offered through the cost savings compared to bullet advances with the puttable. And then we did have some members extend with fixed rate advance structures, both longer term fixed rate and as well as fixed rate amortizing bullets. We saw good growth in those. And then the table or chart to the right shows the distribution of, and it's the count of advances issued in those terms for longer term bullets. You can see a lot of them were short, 4 to 6, and then pretty well distributed after that into some longer terms. Today, a couple strategies we're going to look at involve comparing the SOFR adjustable advance versus a short-term bullet, as well as the line of credit. And we have these 3 listed here as they remain favorable. Opportunities exist for our members. I'm going to go to the next slide. We're going to highlight the SOFR adjustable advance, some key attributes here on the left, and then application of utilizing that funding. We've talked about before the SOFR adjustable advance. The spread component to SOFR that's fixed for life of the advance, and it does give you the repricing. It does reprice daily, and it does have some pricing advantages compared to the overnight line of credit, as well as even some shorter term bullet options. SOFR adjustable advance, we'll see the benefit that it can that you can see for some savings. And then, of course, there's prepayment benefits because of its repricing daily that you get as well with a SOFR adjustable advance. So if you want to move to the next slide, we have a quick case study where we're going to look at comparing the cost of rolling on the OLOC compared to if you were term out a little bit with the SOFR adjustable. So our example here is a member consistently maintains an OLOC balance. What if a portion of funding moved into a 1-month SOFR advance and the remaining provides flexibility should funding needs change? The OLOC can be paid down as needed. On the left, the blue line is going to be OLOC pricing going back to April, and then the green line is going to be the 1, 2, and 3 month SOFR adjustable pricing. The rate for both the 1, 2, and 3 month have been the same, and you can see that the green line is below the blue line for a majority, almost all of that time, and then the SOFR savings there in basis points is there along the bottom, which averages about 4 basis points, 3 to 4 basis points during that term. So what we did is we assumed that 10 million, and we invested that, or I should say, we took down funding in an OLOC versus rolling a 1-month SOFR. And then we assumed the pricing for a 1-month SOFR would have been the same as a 3-month back in September. And we rolled that for a few months to look at what the difference in price would be. And you can see the SOFR savings there was about 4 basis points and saved about $1,700 there in interest cost just for those 4-month period of rolling advances. And then there's certainly an opportunity there to save a few basis points. I did look at members, and we have members that were rolling a balance daily in 2024, or if not, for a significant portion of the year. So this is just something to keep an eye on, keep in your back pocket as a funding option, especially if balances are being maintained on the overnight line of credit. And then we look at one more example of a SOFR adjustable, an opportunity to use this option of funding versus a 1-month fixed rate short-term bullet. And in this example, we have a member that consistently rolls a 1-month short-term fixed rate bullet. And what if a for adjustable advance were used instead? And again, we use the same 10 million. And on the left there, same green lines and blue lines, and then you'll see dashed black lines. And those would be the rate for the term that the short-term fixed rate bullet, when that was outstanding. And we took a look at the cost of each fixed rate bullet for each of those lines that you see there compared to if a 1-month SOFR adjustable would have been utilized instead. And you can see the savings there over time since going back to April. And in the bottom right, you'll see a table, SOFR savings of 6.8 basis points, almost 7 basis points over the life of this term bullet that's been rolling at $5,400 in savings. So pretty, it's a good number, an opportunity to consider when you're looking at doing a little bit longer than OLOC. You need a little bit of term, maybe SOFR adjustable is an option for you. On our daily rate indications, I thought I would highlight where those are. There in the left upper or top left box, we have our short-term bullets and our overnight pricing. And then the second box on the bottom, SOFR adjustable, 1 month, 2 month, 3 month. You can see there the rate that's offered. It's the same for all 3 terms. And then the dividend adjustment, which is important to keep in mind of the benefit you receive from our dividend. And on the next slide, we have an example of a screenshot of our funding strategy illustrations. If you would like to take a look at a couple different structures, short term, medium term, longer term, we can put in rate assumptions for movements with the Fed and what impact that would have on both SOFR adjustable and OLOC and compare to some other term structures for funding. So we have this opportunity or option for you to look at different funding options, and you can reach out to your account manager or the lending desk, and we can run some scenarios for you and play what if.
Leslie, we did have a question here. In respect to the 1 to 3 month terms on SOFR, would the spread component to SOFR remain fixed? For example, today's rate sheet shows about a 10 basis point spread between just the overnight SOFR and the 1 month adjustable product. Essentially, you'd be funding ourselves with SOFR, 10 bips for the given term. Is that the best way to look at it?
The spread, well, the first question, yes, the spread to SOFR is fixed for that term. So for 1 month, so tomorrow, it'll be, if it's 10 basis points, it'll be SOFR plus 10. And that will be for the 1 month, 2 month, or 3 month. That's going to be the rate that will be paid until that comes, it reaches maturity. And then if it's reset, it'll reset at that, whatever the spread is on that date. I will say that SOFR adjustable, this is our most efficiently priced product, and spreads have narrowed. They're tighter now than they have been in the past. So this product is certainly attractive and one of our most efficiently priced products. So yes, you'd be funding yourselves at SOFR plus 10 basis points for the given term. Yes. With that, we will wrap up our funding strategy section for today. Again, if you have any questions on a specific product or would like to compare some options and scenarios, we have some tools that can help you do that. With that, we will turn to an update on HCD.
All right, thank you, Leslie. Just the last few slides here before we wrap up today. We've gone a little bit longer. We had a lot to cover, especially with respect to the policies that the new administration is implementing. So, just as a reminder, because we have some kind of key dates within our affordable housing programs coming up. Just as a reminder, these are kind of the general programs that we offer. Our AHP affordable housing program in general, our turnkey products. So there's going to be all your down payment assistance products, the community housing program, and the community development programs geared towards helping members finance housing in their communities, and qualifying commercial loans, farm loans, and community economic development initiatives. And then lastly, our voluntary programs. So there's going to be things like the NAHI program that we recently rolled out to help our Native American communities in need. So in general, those are the programs that we have. Some upcoming dates on here on this next slide. We have, first things first, just here in a couple weeks, we have the deadlines for the reservation periods on HSP, that's the homeowner set aside program, HSP Plus, and the homeownership possibilities expanded, the HOPE program. So March 3rd is the upcoming date. So get ready for that. The next date will be for the AHP that'll be coming due here this summer, beginning on July 1st. And then we've got the community development programs and the community housing development programs. Of course, those are geared towards just the usage of advances in that space, and it's available year round. So 4 months is the shortest term for those advances, and out to 30 years. Next slide, just covering a little bit more on our some of the voluntary programs. Again, I mentioned the NAHI, that will become available June 2nd. Again, those are up to $500,000 grants per recipient. So if you have any of your customers, or if you have connections with any of the Native American tribes, That has been a huge success, helping our Native American communities. They are very much in need of these types of programs, a lot more lenient because it is within our voluntary space. So we can get a little bit more creative with those types of programs. So by all means, please continue to look into that. The last kind of line item there, we just released, I alluded to it earlier, the mortgage rate reduction product. Our counterparts out in Des Moines had a similar product that we decided to also adopt. Is very, very successful. It will help reduce that mortgage rate without the need to buy down that rate. Of course, that's something that mortgage originators can always offer their customers. But the math kind of comes out the same, right? I'd rather have a cheaper budget, but I've got some money right now that I don't mind, maybe buying down that rate. This is something that can, get that rate down without having to, fork up those costs. Certainly, just like the rest of our grant programs, there's going to be some limitations to how much you can use. But like I said earlier, anything to help kind of creatively get your customer where they need to be when it comes to affordability. It is limited to 80% of AMI, so keep that in mind. But if you have any questions about that, we will certainly get you in touch with our NPF manager, Chris Endicott, and your direct sales representative for your state can answer some questions for you too. So keep in mind that is open currently. It started just a couple weeks ago, February 10th through the end of the year. So keep your eye on that, certainly. Okay, let's go ahead and wrap up here. I'm going to do just some final poll questions to end today. And just regarding our housing development programs, affordability programs, what of those products would you like more education on? So just feel free to select your answer there. Turnkey, that's that down payment assistance programs, AHP, the Affordable Housing Program, NAHI, mortgage rate reduction program, the Community Assistance Recovery Effort, or our Special Advance Program. So put in your answers there. And we will circle back with you, considering based on your responses here, and hopefully get you all of the fodder necessary to get you educated on those types of products. The last poll question there: what form of education would you like that to come from a communication standpoint? Whether it's a webinar, an email, just one-on-one person discussion, or just some little primers or product flyers, or other. And if you have any other ideas on how you want that communicated to you, by all means, we are all ears to what ideas you have there. So looks like we've got most of the responses in. I'm going to go ahead and close out the poll now. Okay. All right. With that, I'll go ahead and wrap up the call here. Just the last kind of couple slides, just to, remind everyone we're here to help. Access to our website, feel free to take a look at the Resource Center tab there on our website. You can see all of our upcoming events. We do have our AMC coming this spring in April. A little different this year. We're going to be hosting it in Wichita. Usually we host it in Kansas City area, but we're going to host it in Wichita. So that's a little bit more convenient for you, or just kind of changing it up. That's got a nice venue there at the Hyatt Regency. It'll be April 16th through April 18th. We've got a great slate of speakers. Of course, we'll all be there from the bank, and looking forward to seeing everybody's smiling faces, and hopefully some good weather. I know here in Oklahoma we're going through a little bit of winter wonderland. Got single digit and negative temps actually this week, and that's why I wasn't able to make it up to Topeka this week. Just the weather was not permitting for safe driving. But if you have any questions on registering or anything like that, let us know. Feel free to bring other folks from your institution. This is our contact information for all of our relationship managers in each one of our states. And don't hesitate to reach out to us. If you have any direct questions for myself or Leslie, just feel free to shoot us an email. If we didn't, I believe we got all to the live questions that you had, but certainly if you have any direct questions, just fire them our way and we'll get back with you. Appreciate everybody's time. Everybody stay warm out there, and we're looking forward to the next call.
Thank you, everyone. And you can visit the website to sign up for future webinars as well.
All right. Thanks, guys. Have a great day.